Alright, welcome back to day fucking 3, boys. We're so fucking locked. Day 3. Welcome back to day 3, boys. Today we're gonna go over fair value gaps. And I hope the majority of the people watching this video don't know what a fair value gap is, so you guys can learn and understand, but I'm sure a good majority of you guys already know what that is. But I'm just gonna make this anyways because I'm sure there's a lot of beginner people watching this and I don't want to skip out on anything, so let's get the fuck into it, boys. So, what are fair value gaps? Wrote this little note thing up here. I'm going to be doing this for every single day, so here we go. Fair value gaps. Price imbalances caused by rapid moves. Now, it doesn't always necessarily need to be rapid moves, but from what I've noticed, a lot of the times, imbalances or fair value gaps that are caused by rapid moves usually have larger displacing candles, and those are the fair value gaps that tend to hold or, get inversed. The ones that basically work towards withdrawing liquidity. What exactly are these fair value gaps? When we create a 3-candle sequence, which is what a fair value gap is, we will leave inefficient price, meaning that that inefficient price is going to get rebalanced to, because it's not balanced yet. It's inefficient. So smart money sees them as zones of inefficiency, so price will either come back into them and respect to continue on, or they will inverse, which is how I trade. I don't like taking fair value gap taps normally, just not my type of style, I guess. But like I said, inverses, that's the way to go. So again, price often retraces to fill these gaps or inverse as well, or inverse that same gap, right? Now, why do these fair value gaps matter? Well, as you can see here, they act as a potential support resistance level. What I mean by that is, let's say you have an FVG. Let's see, what's a good example here? Let's use this one for example. So we have an FVG, we have our gap. Now notice how we're respecting it. This is shown as support. Resistance would be the opposite, as if it's like rejecting off of this fair value gap up here, and then kind of just showing direction off in the other way. It also indicates institutional activity. It's kind of what the banks do: follow order flow, reverse off of high time frame levels, or continue off high time frame levels. So obviously price is drawn to fill these gaps before trending, and you'll notice a lot of the times too that a lot of the times some of the fair value gaps don't get filled, and the reason for that is because, one, let's say this gap right here wasn't filled, right? Most of the time, if it's not filled on NQ and leaves a breakaway gap, meaning a breakaway gap is a gap that's not tapped into and is open, the only couple reasons that will happen is if ES takes that low inside the gap, creating an SMT, which is what I showed in my recap today of that SMT inside that fair value gap. It's the same example. So that's one of the reasons why. Second reason is PD arrays below the fair value gap, meaning that there could be some sort of key level here, an inversion, order block, something like that, that is preventing price to want to come down and rebalance into that open or breakaway gap. So in that case, if it does get left open, like I said, it's going to be a breakaway gap. And it comes really with experience, kind of understanding when it's going to hold, when it's not. You're never going to know 100%. You just kind of have to build up the conviction, build up the confidence to know. So that's what I mean by that, why they matter. They're just inefficiencies in the market, and you can either trade them by tapping into them or inversing them. It's that simple, okay? Now, how can we identify these fair value gaps, okay? Look for large candles, mainly a 3-candle sequence with a minimal wick overlap. What I mean by that is these 3-candle sequence wicks cannot overlap each other. I don't know why I put minimal. Okay, wait, I'll just leave that there. But it has minimal wick overlap, mark the gap between the high and low consecutive candles, and wait for price to return to the gap. So all fair value gap is this. We're just going to use this as a bullish scenario. So we have a gap, the candle here, you're going to have another candle here, and then you're going to have a third candle like this. Boom, that's 3. So this is your FVG. Now, the thing that makes it an FVG is the wicks. So if we mark the wick here, sorry if this is the best representation, I'm just trying to make this as easy as I can. So you're gonna have the first wick or the first candle, the second candle, and third candle. So the gap or the fair value gap or the inefficiency, whatever, in a bullish scenario, it's going to be the top wick of the first candle and also the bottom wick of the third candle in a bullish scenario. All you do is flip this for bearish. That's it. So a lot of the times, if you are bullish and everything is balanced below, you have your SMT, you have your key level, everything that you want to see there, you'll expect price to respect it and then continue on higher, right? Now, the vice versa scenario would be this, right? Let's say we hit a high time frame key level up here with an SMT with a lower drawn liquidity. What do we expect? Maybe another one on stops, one more time, boom, and then we get what? An inversion, meaning we close through it, right? We close through the gap. Sometimes we'll retest it depending on what the structure is doing and depending on the PD arrays around it, but that's all it is. We'll either retest it and trade up off of it or flip for bearish, or we'll inverse it or inverse it the other way and then continue lower, right? That's all it is. That's literally all fair value gap is. It's really, really simple. You just have to see it over and over and over again. So if we're looking at it on just kind of like a normal chart here, there is tons of fair value gaps. I can spot like 15 just by looking right now. All right, so let's zoom in here just so we can just be straight with this. So the inversion that I took earlier today was a 30-second inversion, right? Because it closed through and, you know, it closed through. So that's an inversion to me. If it respected, started to trade lower, since I was bullish today, I wouldn't really short that because it just doesn't make sense aligning with the overall narrative. And if you look here as well, you might be thinking, well, AJ, why didn't you long this if it closed through? We'll get into that later. It's a bit more on the advanced side, but it just comes with me being super picky and knowing when and when not to enter an inversion. It's that simple. So there's one bearish fair value gap. Where's another really obvious bearish one? Right here, look. 1 candle, 2 candle, 3 candle. Top wick of the first one, bottom wick of the third one. Boom, that's a fair value gap. Where's another bullish one? Or sorry, where is a bullish one? Right here, bottom wick of the first, or top wick of the first candle, bottom wick of the third candle. That's your gap. Right here again, top wick of the first candle, or bottom wick of the first candle, top wick of the third candle. It doesn't need to be the same color. As long as it's a three candle sequence with wicks not overlapping, meaning we don't want to see something like this. So if we see something like that, where's the gap? What are you gonna mark? There is no gap, bro, because this wick here, I mean, there's an open space from here, but this whole wick here rebalanced that entire price, so there's no gap, right? So I'll remove that, obviously, because there is a gap there, but this is what you're looking at. Fair value gap right here. Boom. Where's another bullish one? Right here. Top wick of the first candle, bottom wick of the third candle. That's it. So you shouldn't always be looking for every single fair value gap to hold or looking for every single fair value gap to inverse. You have to align it with the narrative of the drawn liquidity and align it with the manipulation, align it with time, align it with price. That's the most important thing, because if you can learn to align it with time and price, you'll be able to catch tons of good inversions, tons of good, silver bullet, 2022 model type trades, right? And, just be consistent overall with it. So fair value gaps really aren't that complicated, to be honest. That's why I'm going to keep this video quite short for day 3, but they're not that complicated. That's it. They're just 3 candle sequence without overlapping wicks. And again, it doesn't have to be wicks. Let me see if I can find an example of a fair value gap that doesn't have a wick on one of the ends. I don't think I'll be able to find any right now because I don't think we got any. But an example of it would be like something like this. Let's say, this wick here at this candle at 938. Let's say this wick didn't exist and there was just a body. That would still be a valid gap, right? And if there's a larger space between the close and the open, that would be a volume imbalance. Now, I'll explain that in here too, because I'm not going to make a separate video just on volume imbalances, so I'll just throw it in here. this would be a very good example of a volume imbalance. So let me remove this out of the way right here. So you'll notice this candle opens here, closes here, right? So the space between the space between the close and the opening price is the volume imbalance. So this small little space right here is your volume imbalance. And you'll notice some candles here, there's no space, right? We have the close, the open, no space, right? Close, open, no space, right? That's not a volume imbalance. So if you do get a fair value gap like that, let's say the wick is really close towards the volume imbalance, you're gonna mark the volume imbalance too. Because a lot of the times with inverses, we'll close through the gap, but we will wick the volume imbalance, telling us that we still want to trade higher and it's not ready to short yet, and flip for, you know, a bullish scenario. And that's exactly what I mean by volume imbalance. It's just an imbalance within volume, right? It's evened out here because we close and open at the same exact price as where we closed from on the previous candle. Right here, we close, but we open, what is this? We open 1.5 points from where we closed from. So that's your imbalance in volume, your volume imbalance. That's literally it. So fair value gaps, volume imbalances, whatever. So how can we understand how to trade these, whatever? Like I said, it's not that complicated. If you look at my recaps, you'll understand that I look for high time frame key levels. And when I mean high time frame, it could be, 15 minute, 30 minute. I can even count a 5-minute gap as a high time frame key level as long as it's aligned with the drawn liquidity and the bias. Okay? It doesn't need to always be an hourly fair value gap or a 30-minute fair value gap. You shouldn't think of it mechanically. It should be logically and narratively backed. That's how you should view fair value gaps, and that's how you should view taking these trades, whether it's going to be an inversion or just a tap. So it all comes down honestly to your discretion and how you want to trade. I can't tell you how to trade. It's up to you. Okay? So yeah, like I said, wait for retrace and confirmation if you're going to go in with that 2022 type model, and obviously confirmation would be that inversion, which I recommend has a way higher win rate than tapping an FVG. Most of the time you're going to get stopped out by that. So stick with inversions, trust me. All right. Now you can combine other tools, rectangles, fib, stuff like that. What I mean by this, obviously we have our rectangles like I just explained. It's an easy tool. Just go to the 1, 2, 3, 4, 5, the 6th tool section down, and then you'll have the rectangle there. So that's really useful. And you could also use fibs if you really want to, because the fib is technically, you can use that for finding equilibrium, stuff like that, and finding, CE or consequent encroachment of the fair value gap or the midpoint between the fair value gap. I don't really use CE because I never really see a point of it mattering to me. So all I use for tool-wise is just this. I just wanted to throw more things in here to make the page look cool. So yeah, it's just me being honest. Now, in terms of stop loss, placement, stuff like that, since I'm trading this inversion here, right? Why do I put my stop down here? Well, even though we inverse this gap and have a big wick here rebalancing off this equilibrium of this range, there's still a chance that price could come and fill this gap, right? So a lot of the times you're going to want to put your stop loss just below the gap to get a really nice RR, but other times if market structure is telling you otherwise, it's better safe than sorry, right? Have a bigger stop, have a little bit more risk on the table to avoid getting wicked out and hitting straight to your TP. So that's kind of like what I go off of. If you're more of like the inversion tap, or not the inversion, if you're more like the just kind of normal fair value gap type of guy, it would just go above the recent swing high of whatever you're trying to trade, right? Same, almost kind of the same concept, but you get the gist, I guess. Sure, you guys know, at least some of you guys know how to trade the 2022 model, right? But yeah, so that's pretty much trading FEGs. Obviously, we're gonna get into way more, in-depth videos, advanced techniques on how to actually use these fair value gaps, very precisely. But just for now, we're just gonna stick with the basics and understand what the hell fair value gaps even are, right? Because I know some people have some issues with it, but I mean that was all of us at one point in our lives. So some tips here that I also wrote out for you guys. Focus on higher time frames for clearer FEGs. Notice a lot of the time, if you're on the 1 minute time frame and you're constantly looking for fair value gaps to tap or inverse or this and that and this or whatever, you're probably going to get stopped out quite a bit. And you probably don't want that. You want a pretty significant high win rate, especially if you're trading prop firms. Obviously because of their trailing drawdown rules, at least for Apex and whatever else, but seriously, focus on higher time frames to find your overall bias, okay? So, yeah, and then use confluences to improve trade accuracy, like SMT, a breaker, maybe a unicorn, which is literally a fair value gap aligned with a breaker. It's a good one to use as well. And yeah, I mean, fair value gaps help predict price movement by aligning with smart money strategies. And what I mean by that is it just follows order flow and how the institutions and all these big banks trade with all these, hundreds of millions, if not billions of dollars. So the whole idea is just following these guys' footsteps and understanding how order flow and market structure really play out every single day in the markets. And remember too, price is always fractal. Whatever happens on a 1 minute will happen on a 4 hour, daily, weekly. Obviously, the 1 hour and up is going to be a lot more clear in terms of, finding out where price is going to go, where it's going to rebalance. 1 minute, it's a bit more kind of wonky. You're going to have a lot of different things happening at once, and that comes with more experience. The longer you trade, you'll be able to see these things over and over and over again, and you're going to be able to frame certain ideas and different biases when you see these certain movements happen in the chart. So yeah, like I said, I don't want to make this video too long. I'm probably just going to leave it off there. I hope this was informative. If there's anything that I'm missing at all, please let me know down in the comments below. I don't want to miss out on anything. If there's any questions or comments that you guys have, leave them down below. Please don't be scared. Leave them down below. I am nice. I will respond. I'm not a dick, okay? Just letting you guys know. I'm the nicest guy ever. All right? So, yeah, I'll leave you boys with that. Please leave a like on the video. Subscribe. We have a lot more days coming. This is only day 3, guys. This is only day 3. So, yeah, boys, I'll leave you guys with that. And I'll see you guys tomorrow for day 4. And I'll see you on Monday for the next trading day, potentially. Maybe Tuesday. I don't know. We'll see. But, yeah. Peace.